Welcome back to the deep dive. Today, we are not just talking about money. We are talking about what might be the single most expensive private education in the history of Wall Street.
That is a great way to put it.
We're going to unpack a story that involves, and I don't use this term lightly, the absolute smartest people on the planet.
Truly. I mean, certified geniuses.
And these certified geniuses managed to effectively set a pile of $4.5 billion on fire. And not over a decade, but in a matter of, less than 4 months.
It's the ultimate Icarus story. You know, it has absolutely everything. Hubris, genius, what seemed like unlimited capital, and just a catastrophic ending that almost, and this is not an exaggeration, almost took down the entire global economy.
We are talking, of course, about long-term capital management, or LTCM, as everyone came to know it. And before we really get into the weeds here, I just want to frame the stakes for everyone listening.
Yeah, this is important.
This isn't just a story about some hedge fund that had a bad quarter. This is a story about a fund that became so big, so leveraged, and so interconnected that when it started to crack in 1998, the Federal Reserve, we're talking the Central Bank of the United States, had to step in.
Had to orchestrate a bailout.
They were genuinely terrified that if LTCM fell, it would cause a complete systemic freeze.
And that's not hyperbole. I mean, the real fear, the thing that kept the Fed chairman up at night, was that the actual plumbing of the global financial system would just stop working.
So if this one fund in Greenwich, Connecticut went under, ATMs might stop dispensing cash.
Corporate payrolls might bounce. I mean, that was the level of panic we're talking about. A true meltdown.
Okay. So our mission today is to reverse engineer this disaster. We're going to look at the dream team they assembled. We'll get into the specific trading strategies that made them billions in the first place.
And then the fatal flaw, the mathematical blind spot in their risk models that they just couldn't see.
And then, the minute-by-minute panic of the bailout. We've got a massive stack of sources here. Biographies, Fed transcripts, trading logs, academic autopsies of the crash. I mean, this is one of the most studied financial events in history.
It is. And I think, if there's one big theme to look out for today, it's the difference between intelligence and wisdom.
Oh, that's good.
You're going to hear about Nobel Prize winners. You're going to hear about guys who literally invented the math that, Wall Street still uses today. They were so incredibly intelligent.
Beyond intelligent.
But as we'll see, they lacked a certain kind of street smarts, a survival instinct. They mistook the map for the territory.
I love that. The map is not the territory. Let's start at the very beginning then, the assembly of this team. Because like you said, this wasn't just some guys in a garage with a Bloomberg terminal. This was the 1927 Yankees of finance.
I really was.
And it all starts with one man, John Meriwether. Who is this guy?
John Meriwether is or was a legend. Before LTCM, he was at Salomon Brothers in the 1980s. Now, if you've ever read Michael Lewis's book, Liar's Poker,
Oh, a classic.
you know the culture of Salomon at that time. It was aggressive, it was
Yeah.
loud, it was full of, to use their terminology, big swinging dicks.
Right. A pure alpha male environment.
Absolutely.
Huh.
But Meriwether was, he was different. He was the exception to the rule.
Oh, so?
He was quiet. He was cerebral. He wasn't the guy screaming across the trading floor, throwing phones. He was the guy staring at the numbers, seeing these tiny patterns that nobody else saw.
And he ran the bond arbitrage desk, right?
He did.
Yeah.
And to give you a sense of just how important he was to that firm, in the late 80s and early 90s, Meriwether's specific group, just his desk, was reportedly responsible for something like 80 to 100% of Salomon Brothers' total global earnings.
Wait, say that again? 80 to 100%?
Of the entire bank's profits.
That's wild. One desk was basically carrying a global investment bank on its back?
Exactly. He was the golden goose, which is why it was such a big deal when he left in 1991. There was a trading scandal involving treasury auctions. Now, it wasn't something he did personally, mind you, but it happened on his watch.
So he took the fall for it?
He took responsibility, yes, and he resigned. But his reputation was so pristine, so legendary, that when he decided to start his own shop a couple of years later, in '93, people were practically throwing money at him. They were lining up.
But he didn't just bring his old traders with him, did he? This is where the story gets really interesting. He went out and recruited the academic heavyweights.
This was his brilliant move. He decided to bridge the gap between the ivory tower of academia and the dirty fingernails world of the trading floor. He recruited the intellectual giants of finance.
Specifically Myron, Scholes, and Robert C. Merton.
Yep. Now, For anyone who hasn't suffered through a university finance degree, those names are, well, they're effectively gods.
These are the Scholes and Merton you read about in the textbooks.
Precisely. They, along with a third academic named Fisher-Black, created the Black-Scholes model. This is the formula, the math, that allows you to accurately price stock options. Before them, pricing a derivative was. It was a guessing game. It was all intuition and gut feeling.
They turned it into a science.
They turned finance into physics. That's the key. They gave it the veneer of scientific certainty.
And just to underscore how big a deal this was, these two guys, Scholes and Merton, they won the Nobel Prize in economics in 1997.
While they were working at LTCM.
Right. So imagine you're a potential investor. You're sitting in a meeting, and the pitch is, we have the greatest bond trader of his generation, John Meriwether. And on our board, we have the guys who literally wrote the laws of physics for the market. Oh, and by the way, they just won the Nobel Prize.
It created this aura of infallibility, didn't it? It wasn't gambling anymore.
No.
It was science. They weren't betting on gut instinct. They were harvesting what they saw as mathematical certainties.
And the structure of the fund itself, it sort of reflected that exclusivity, that arrogance almost. They weren't on Wall Street.
No, they set up in Greenwich, Connecticut. They wanted to be physically removed from the noise and the emotion, the panic of New York City. It was designed to be very academic, very quiet, just supercomputers and silence.
And very unregulated.
Oh, absolutely. They used an exemption in the Investment Company Act of 1940. Basically, if you only take money from highly sophisticated, very wealthy investors, you don't have to tell the SEC, the regulator, much of anything.
Which means they could be secretive.
Extremely. They told their investors absolutely nothing about what they were actually trading. It was a total black box. The deal was, you give us the money, we give you incredible returns, and you do not ask how the sausage is made.
And people lined up for that deal.
They couldn't get the money in fast enough. By the time they launched in February 1994, they had amassed just over $1.01 billion in capital. For a hedge fund launch at that time, that was a massive, massive number.
Okay, so the dream team is assembled. They have the capital. They have the Nobel Prize-winning brains. Now we need to understand the machine. How did they actually make those billions? Because the phrase bond arbitrage sounds incredibly boring.
It does, doesn't it?
But clearly, it was incredibly lucrative.
It's lucrative if you do it at their scale. The core strategy was something called convergence trading.
All right, lay it on me. Simple terms, what is that?
The fundamental belief of LTCM was that markets are efficient. Eventually. But in the short term, they can be inefficient.
So things get out of whack for a little while.
Exactly. Sometimes two things that are essentially the same, that should have the same price, they trade at slightly different prices.
Yeah.
Maybe due to a temporary supply and demand quirk or a liquidity issue in the market. A convergence trade is a bet that eventually those prices will converge. They'll snap back together.
Okay. Can we use the old versus new bond trade? I saw that in the notes, and it seems like it was their bread and butter.
It absolutely was. It's the perfect example. So think about U.S. Treasury bonds. The U.S. government issues 30-year bonds all the time. When a brand new 30-year bond is issued, it's called the on-the-run bond.
It's a shiny new thing.
It's the shiny new thing. It's incredibly liquid. Everybody wants it. Pension funds, foreign governments, other banks, they all want the newest, most actively traded issue.
It's like the new iPhone. Everyone pays a little premium for the new iPhone, even if last year's model is basically the same.
That's a perfect analogy. Because it's the new iPhone, people are willing to pay a tiny, tiny premium for it. Now, you look at a bond that was issued, say, 3 months ago.
Right.
It's now technically a 29.75-year bond.
Right.
The cash flows from these two bonds, I mean, they're almost identical. The credit risk is identical. It's the U.S. government. They're going to pay you back.
So it's basically the same product.
It is. But that older bond, it's harder to trade. It's less liquid. It's called off the run. And because of that, it trades just a little bit cheaper.
So you have two things that are worth almost exactly the same, but one is expensive and one is cheap, just because of liquidity.
Correct. So LTCM's computer models would scan the market and spot this tiny discrepancy, and they'd make a trade. They would short the expensive new bond betting, its price would go down relative to the other, and they would simultaneously buy the cheap old bond, betting its price would go up.
And the key is, they didn't care if the overall market went up or down.
Didn't matter at all. Interest rates could go to the moon or to zero. All they needed was for the gap, the spread between those two bonds, to close. They just needed the prices to converge.
Because eventually, the new bond becomes an old bond.
Exactly. The moment the Treasury holds its next auction and issues an even newer bond, the on-the-run becomes off-the-run. The premium evaporates. The spread closes. It's a mathematical certainty, or so they thought.
Okay, but here's the catch, right? The difference in price between those two bonds, the spread, it can't be very big. We're talking pennies, aren't we? Or like fractions of pennies.
We call them basis points.
Hmm.
And yes, it is tiny. You are literally picking up nickels. If you or I did this with $1,000, we might make enough money to buy a stick of gum.
It's very low risk, theoretically, but it's also very, very low return.
That's the problem with pure arbitrage.
So how on earth do you generate 40% annual returns from a stick of gum strategy?
One word. Leverage.
Ah,
Massive, mind-boggling leverage.
this is the scary part of the story.
This is the fuel that they poured on the fire. Since the spreads were so small, like you said, like picking up nickels, they figured they had to use a bulldozer to pick up enough of them to make it worthwhile.
And a bulldozer means borrowed money.
Lots and lots of borrowed money. They borrowed from every bank on Wall Street to amplify their bets.
I'm looking at the numbers here for the start of 1998. They had about $4.7 billion in their own equity, their own capital, which is a lot of money.
A huge amount.
But they had borrowed over $124.5 billion.
It's just an insane number. That is a debt-to-equity ratio of over 25-to-1. For every single dollar of their own money in the fund, they were playing with $25 of someone else's money.
And that's just the stuff on the balance sheet, right? That's what they reported. What about the derivatives?
Yeah, that's the shadow exposure, the really scary part. Off the balance sheet, they had positions, mostly things like interest rate swaps, with a notional value of $1.25 trillion.
Trillion, with a T.
With a T.
I mean, it's hard to even wrap your head around a number that big.
It is. To put it in perspective, they took an equity base of less than $5 billion and turned it into a market footprint that rivaled the GDP of a country like Spain or Canada.
Yeah.
It was immense. And for a while, it worked beautifully.
Until it didn't.
Until it didn't. Because leverage, it cuts both ways. If you're leveraged 25-to-1, a tiny 4% drop in the value of your assets wipes out 100% of your equity. You're at zero. Gone.
And that's where that famous analogy comes from, isn't it? The strategy was compared to picking up nickels in front of a bulldozer.
Yes. You make small, reliable gains day after day after day, but there is a very small, non-zero chance that one day the bulldozer will move and you'll get completely flattened.
But for the first 3 years, from 94 to 97, that bulldozer was parked in the garage. They were just crushing it.
They were the kings of the world. I mean, look at the early returns. Year 1, 21% after fees. Year 2, 43%. Year 3, 41%.
Unbelievable numbers.
They were the envy of all of Wall Street. They felt completely untouchable.
So what changed? We get to 1997, and the seeds of destruction start to get planted. Things start to look a little different.
Well, the first problem was, ironically, their own success. Arbitrage opportunities are basically market inefficiencies. Once a smart person finds an inefficiency and exploits it, it tends to, well, disappear.
Because other people comp to you.
Exactly. LTCM was so successful, so famous, that copycats started showing up. Other firms, other banks, they all said, hey, we can do that on the run, off the run bond trade too.
So suddenly there were too many people trying to pick up the same nickels.
That's it, exactly. And when that happens, the spreads get tighter and tighter, the opportunities get smaller, and you can see it in their numbers. In 1997, their returns dropped to 17%.
Which for you or me, 17% is a fantastic year. We'd be thrilled.
We'd be retiring.
Yeah.
But for the geniuses in Greenwich charging these massive fees,
It was an embarrassment.
it was a failure. It barely beat the S&P 500 stock market index that year. They were under immense pressure, a lot of it internal, to keep the magic alive, to keep posting those 40% numbers.
And this leads to something called style drift. I love this term because it sounds so harmless, so academic, but it's actually incredibly dangerous.
It's the beginning of the end for so many great investors. Style drift is what happens when you move away from your core competency, your area of expertise, because the returns just aren't there anymore. You start, betting on things you don't understand quite as well.
LTCM was the king of fixed income arbitrage. They knew U.S. bonds, European bonds, Japanese bonds inside and out. But suddenly they're looking at other stuff.
That's right. They started moving into equity volatility, merger arbitrage, and this is the crucial part, emerging market debt. They were buying Russian bonds, Brazilian bonds, Pi bonds, and this was a source of internal debate. Myron Scholes himself, the Nobel winner, actually warned the other partners about this. He said, and this is a quote, that they had no informational advantage in trading things like the Norwegian krone.
But they did it anyway.
They did. They needed the yield. They felt their models, their mathematical approach, could be applied to anything. If the math works for U.S. Treasuries, why wouldn't it work for a currency in Norway?
It shows a certain level of hubris, a belief that math trumps the local knowledge.
It's pure hubris. And there's another story from this period, this UBS tax scheme, that I think really shows their mindset. It's a clear sign that they were getting too cute for their own good.
What was that about?
It was financial engineering at its absolute peak. The partners wanted to treat their income as long-term capital gains to pay a lower tax rate, about 20% versus almost 40% for ordinary income. So they set up this incredibly complex call option structure with the Swiss bank UBS.
I'm not even going to pretend to understand the details.
The details are a nightmare. But the takeaway is that they were using their immense brain power not to find value in the market, but to game the tax code. It just showed a belief that they could outsmart any system, whether it was the market or the IRS.
And it was a distraction.
A huge one. And it brought UBS way too close to them, which would come back to haunt the bank later.
Before we get to the final crash, we have to talk about one specific trade that went wrong, the Royal Dutch Shell trade. This one feels like the perfect microcosm of their entire model failing.
It is the classic example. So Royal Dutch and Shell were, at the time, a dual-listed company. Basically two different stocks, but for the same underlying company. The economic value of the whole enterprise was split 60-40 between them.
So theoretically, the two stocks should move in perfect lockstep.
They should, right. If the company makes more money, both stocks should go up by roughly the same percentage.
Yeah.
But for historical reasons, they didn't. They traded at different prices. Royal Dutch consistently traded at a premium to Shell.
And LTCM looked at this, and their model screamed inefficiency.
Their model screamed, "This is wrong. Matt says these prices should converge." So they put on a massive trade. They bet $2.3 billion that the spread would close. They shorted the expensive Royal Dutch stock and went long the cheaper Shell stock.
A classic convergence trade? What happened?
The market decided it didn't care about their math. The premium didn't shrink. It widened dramatically. It went from about 8 or 10% to over 22%.
So the trade went completely against them.
Completely.
Mm.
And they lost hundreds of millions of dollars on that one trade alone. It was a brutal lesson.
It really is the old John Maynard Keynes saying, isn't it? The market can remain irrational longer than you can remain solvent.
Precisely. Their model said, this must happen, and reality said, yeah, maybe, but not today. And not before you go broke.
Which brings us to the really big question, the blind spot. We talked about the geniuses, the Nobel winners, the supercomputers. How did they miss this? How are their models so fundamentally wrong?
It really comes down to one thing, data. Or more specifically, a lack of it. Their primary risk model was something called value at risk, or VAR.
VAR? I've heard of this.
Most banks use some version of it. It's a model that tries to calculate the maximum amount of money you might lose on any given day based on historical patterns.
Okay, based on historical patterns, that sounds reasonable.
It is reasonable if, and this is a very big if you use enough history, the fatal flaw, the blind spot for LTCM, was that their models were largely built on data from the previous 5 years.
5 years, that's it, from what, 93 to 98?
Basically, yes. And what was happening in the early to mid-90s, it was a generally calm, steadily rising bull market period.
Right. Not a lot of volatility.
Very little. By using only 5 years of data, they completely, totally excluded the 1987 stock market crash. They excluded the bond market crisis of '94. They excluded the 1917 Russian default, which might have been a useful thing to have in their models.
So their models basically assumed that a major global crash was impossible because it hadn't happened recently.
Their models assumed it was a statistical impossibility. The historian Neil Ferguson had this absolutely brutal quote about it. He said, "The Nobel Prize winners had known plenty of mathematics, but not enough history."
Ouch. That's a perfect summary.
It is. Their models predicted that the kind of daily loss they eventually suffered in August '98 was what's called a 10 sigma event. It was an event that should happen only once in the entire life of the universe.
And yet it happened on a Tuesday.
Exactly. Because in the real world, financial markets don't follow a perfect bell curve. Real life has fat tails.
Okay, fat tails. Explain that.
So think of a normal bell curve. In a normal distribution, the tails, the extreme events way out on the left and right, are very, very thin. They almost never happen. In financial markets, the tails are fat. Crashes, panics, defaults, pandemics. These extreme universe-ending events happen way more often than a standard statistical model predicts.
And LTCM bet their entire firm and $120 billion of borrowed money that the tails were thin.
They bet the farm on it. And then in August 1998, they found out just how fat those tails could be. The perfect storm arrived.
And it started in Russia.
It started in Russia. On August 17, 1998, the Russian government defaults on its domestic debt.
Now, hold on. Why was this such a massive surprise? I mean, governments go broke sometimes, right?
They do, but they usually default on debt issued in a foreign currency, like U.S. dollars. The conventional wisdom at the time was that a sovereign nation would never default on debt issued in its own currency.
Because they can just print more money to pay it off.
Right. It would cause hyperinflation, sure, but they wouldn't technically default. Russia proved that entire school of thought wrong. They just said, nope, we aren't paying.
And that one event sent shockwaves through the entire global system.
It triggered a global panic. I mean, a real visceral panic. Investors everywhere woke up and collectively realized the world was a much more dangerous place than they thought. And when investors get scared, they all do the exact same thing.
Flight to quality.
Flight to quality. They sell anything that looks even remotely risky.
Emerging market bonds, junk bonds, corporate bonds.
Anything with hair on it. They sold it all. And they poured all of that money into the safest, most liquid asset on planet Earth.
Brand new.
On-the-run U.S. Treasury bonds.
Wait a minute, that sounds familiar. That's the exact asset LTCM was shorting as the expensive side of their trade.
You nailed it. LTCM was fundamentally betting that the spread between the risky stuff and the safe stuff would shrink. Instead, because of this global panic, that spread blew out to historic widths. The safe bonds they were short got massively, insanely expensive because everyone in the world wanted them. And the illiquid risky bonds they owned got dirt cheap because no one wanted to touch them.
So every single one of their core convergence trades went the wrong way at the exact same time.
Every single one. The fundamental assumption of their models was that all these different trades were uncorrelated. But in a crisis, that's not true. In a crisis, the only thing that rises is correlation. Everything you own goes down and everything you're short goes up.
And to make matters worse, Salomon Brothers, Meriwether's old firm, had just decided to exit the arbitrage business right before this in July '98.
That was just the worst possible luck. It was the nail in the coffin. Salomon had a portfolio that looked almost exactly like LTCM's. When Salomon started to liquidate their positions, they were selling all the same things LTCM owned, which pushed the prices down even further, faster.
It was like a run on the bank, but the bank was the entire global bond market.
There was no liquidity, no bids. They were trapped.
So let's look at the damage. The numbers are just breathtaking. August of 1998, their losses were $1.85 billion in 1 month.
And it gets worse. September starts, and the equity in the fund just evaporates. It drops from $2.3 billion at the start of the month to just $400 million by the third week.
And remember the leverage. As their equity base shrank to almost nothing, their leverage ratio just skyrocketed.
It went from 25 to 1 to over 250 to 1.
250 to 1. That's not investing. That's not even gambling. That is just pure, desperate prayer.
And by this point, the sharks were circling. The rest of Wall Street could smell blood in the water. Other traders knew LTCM was in deep trouble. They knew LTCM had to sell their positions to meet margin calls. So what do?
You front-run them. You sell the same things before they do, driving the prices down even more, forcing them to take even bigger losses when they finally have to sell.
It's a brutal, vicious death spiral. Yeah. And they were caught right in the middle of it.
So this is it. The fund is collapsing. And now we get to the bailout. And this is the part of the story that really highlights how dangerous this whole situation had become. It wasn't just that some rich guys in Connecticut were losing money. The Federal Reserve got involved. Why?
Systemic risk. That's the phrase you'll hear over and over. LTCM was so deeply interconnected with every major investment bank on Wall Street. They had those trillions of dollars in derivative contracts. If LTCM just collapsed overnight and defaulted on all those contracts, they would have left massive, gaping holes in the balance sheets of Merrill Lynch, Goldman Sachs, UBS, JP Morgan, everyone.
It would have been a domino effect. One falls, they all fall.
The Fed was terrified it would freeze the global financial system.
Yeah.
That credit would just stop flowing between banks, that markets would crash. It was a genuine fear of a 1929-style event.
So on September 23rd, 1998, the New York Fed calls a meeting.
And it wasn't just a meeting, it was a summons. They basically locked the heads of all the major banks in a conference room at the Federal Reserve Bank of New York and said, we have a problem.
But before that final meeting, there was this incredible moment where Warren Buffett almost bought the whole thing, right?
Yes, this is one of the great what-ifs in financial history. Warren Buffett, along with Goldman Sachs and AIG, made an offer to buy out the partners and take over the fund. They offered $250 million for the partners' stake.
250 million. They had started the year with nearly 2 billion of their own money in there.
It was pennies on the dollar. It was a total humiliation. But it was also the only offer on the table. And Buffett, being Buffett, put a very specific condition on it. He gave them less than 1 hour to decide.
1 hour to decide the fate of their entire firm.
He didn't want to get into a negotiation. He faxed them the offer and said, "You have until this time to say yes or no." But apparently the structure of the offer was complicated, or Meriwether couldn't get the legal sign-off in time. Whatever the reason, the hour lapsed. The deal died.
So they were left with the Fed, with the government.
Well, with the Fed playing chaperone, this is an important distinction. The Fed didn't want to use public money. This wasn't a taxpayer bailout like we saw in 2008. The Fed's role was to act as an organizer, or maybe an enforcer.
They basically told the banks, you guys created this monster by lending him all this money.
You enabled them, so you guys need to fix it. If you don't all chip in to save this fund, you are all going down with it.
That is some serious arm twisting from the central bank.
It worked. 14 banks agreed to inject $3.625 billion of new capital into the fund to keep it afloat. In exchange, they effectively took 90% ownership of LTCM.
But not everyone played ball, did they? There was a famous holdout.
Bear Stearns.
Bear Stearns declined to participate.
They did. They were the clearing agent for LTCM, which meant they had a lot of exposure already. They refused to put any new money into the pot. They essentially said, "We've got enough risk, thanks."
Wow. That is just rich with irony, considering what happened to Bear Stearns almost exactly 10 years later in 2008.
It is. A lot of people on Wall Street remembered that moment when Bear Stearns came asking for help in 2008. Let's just say they didn't have a lot of friends left in the room.
So the banks put the money in, they stabilized the fund. What happened to the partners? The dream team? Meriwether, Scholes, Merton.
They were completely wiped out. They had $1.9 billion of their own personal money invested in the fund.
All gone.
All gone. They were left with a tiny sliver of equity that was basically worthless, consumed by the debt. They lost their personal fortunes. They lost their reputations. It was a total and complete financial ruin for them.
But the banks, the ones who put up the bailout money, they eventually got paid back.
They did. And then some. Once the immediate panic subsided and that flight to quality reversed, those convergence rates actually started to work again. The spreads started to close. The liquidation of the fund was orderly. By early 2000, the fund was completely dissolved, and the banks got all their money back, plus a small profit.
So in the end, disaster averted. The system was saved.
In the short term, yes, the immediate fire was put out. But in the long term, no, maybe not. The solution might have planted the seeds for an even bigger crisis down the road.
Okay, this brings us to the analysis, the aftermath. What did we learn from this? Or maybe, what did we fail to learn?
I think the single biggest concept that comes out of this is moral hazard.
Explain that first.
Moral hazard is the idea that if you protect people from the consequences of their risks, they will naturally take even bigger and crazier risks in the future. By orchestrating this private sector rescue, the Fed, and specifically the chairman at the time, Alan Greenspan, signaled to the market that if a financial firm is too big to fail, the Fed will always step in and organize a lifeboat.
This is the famous Greenspan put, right?
Exactly. It's the belief that there's a safety net underneath the market provided by the central bank. And it arguably set the stage for the massive, excessive risk-taking we saw in the housing market that led to the 2008 crisis. Banks thought, we can lend to risky hedge funds, we could load up on subprime mortgages, because if it all blows up, the Fed will save us.
So the rescue itself created a bigger problem.
Many people argue it did.
And what about the players? Surely Meriwether and the Nobel winners retired to a quiet life of teaching and writing their memoirs.
You would absolutely think so. You would think after a humiliation of that magnitude, you'd never show your face on Wall Street again. But no. John Meriwether launched a new fund, JWM Partners, in 1999.
You are kidding me. Less than a year after the collapse.
Not even a year. And guess what strategy he used in his new fund?
Please don't tell me it was the same one.
It was the exact same strategy. Fixed income arbitrage, just with slightly less leverage.
And how did that one go?
It actually worked pretty well for a while. Yeah. Until the 2008 financial crisis hit. And then JWM Partners lost 44% of its value, and had to shut down.
It's unbelievable. It's like they were so convinced their model was right that 98 was just a fluke, a one-time thing.
It suggests a real addiction to the model, a core belief that this time is different or we've fixed the bug. They just couldn't let it go.
And what about the banks involved? UBS took a huge hit, right, from that tax scheme.
They did. The chairman of UBS was forced to resign. The bank lost nearly $800 million, mostly related to those clever tax schemes and the put options they'd written for LTCM. It was a career ender for a lot of very senior people.
Let's just tally the final bill on the fund itself. The total loss was $4.6 billion. How did that break down?
The sources show about $1.6 billion was lost in swaps, $1.3 billion in equity volatility trades. And, what's really interesting is that only $430 million was actually lost in Russia directly.
Wow. So the trigger event, the Russian default, was actually a pretty small part of the total loss.
A tiny part. It wasn't the default that killed them. It was the ripple effect. The global panic, the flight to quality, and most importantly, the liquidity drying up. That's what killed them.
There's a saying that liquidity is like oxygen.
That's perfect.
You don't notice it at all when it's there. You take it for granted, but the second it's gone, it's the only thing in the world that matters.
And LTCM suffocated.
So we've unpacked the rise, the strategy, the spectacular crash, and the controversial bailout. When you step back and look at the whole story, what is the big takeaway for you? If you had to summarize the lesson of LTCM in just one thought.
For me, it comes back to what I said at the start. It's the profound difference between intelligence and wisdom. These men were, without question, some of the most intelligent people ever to work in finance. They could calculate the price of a complex derivative to the 10th decimal place in their heads.
Certified geniuses.
But they lacked the wisdom to understand that the real world doesn't always follow the clean, elegant rules of mathematics. They mistook their map for the actual territory.
I love that phrase. The map is not the territory. Just because your model, your map says a 10 sigma crash is impossible doesn't mean the market can't crash.
And more specifically, I think it's the ultimate cautionary tale about the danger of leverage. Leverage doesn't make you a better investor. It just magnifies your outcome. If you're right, you win big. If you're wrong, you get wiped out. They were smart enough to be right 99% of the time, but leverage meant that the 1% of the time they were wrong, it was fatal.
And history. You have to look at more than just the last 5 years of data.
Always.
Yeah.
History is a long, messy, complicated book. And if you only read the last chapter, you are absolutely going to be surprised by the plot twist.
So before we wrap this up, I want to leave our listeners with one final provocative thought to chew on. We mentioned that Meriwether started a second fund that failed in 2008. But the source material notes that he launched a third fund in 2010.
JM Advisors Management, yeah. Unbelievable.
Like using the same basic strategy all over again.
He just can't quit it.
It raises a really fascinating question, I think. Is the allure of this kind of easy mathematical scientific money so powerful that even a $4.6 billion failure, a global public humiliation, can't break the addiction? And then you have to think about today's market.
Right.
It is completely dominated by algorithmic trading, high-frequency trading, AI models making decisions.
We have faster computers and way more data than they ever did.
You do. But do we have more wisdom? Or have we just built a bigger, faster, more powerful bulldozer? If LTCM could almost break the world in 1998 with, Excel spreadsheets and telephones, what happens when the algorithms that run our entire market today all decide to rush for the same exit at the exact same millisecond?
That is a terrifying thought. The fat tail might be even fatter next time.
On that cheery note, thank you for joining us on this deep dive into the rise and spectacular fall of long-term capital management. It's a story of genius, ruin, and the razor-thin line that separates the two.
Thanks for having me. It was great to talk through.
We'll see you on the next deep dive.